We've been talking about the movement in equities and the fact that we're continuing to see records hit in the US and here in Asia too today. Binay, valuations rich, but do you also start to look at the fact that some of these markets could be overpriced, or are you still a buyer here?
No, we're still more in the camp of allocating more to equities if the markets do sell off on disappointing news, either linked to elections or linked to the resurgence in COVID cases. Because the alternative to not owning equities, which is the growth asset, is going into very defensive fixed income, where the return potential is even lower. You know, government bonds are yielding about 0.5% on average globally in developed markets, much lower in emerging markets as well as compared to the history. Therefore, for investors looking to get some kind of nominal return in their portfolio, equities, we think, is still the way to go for 2021.
Let's talk as well about what we've been seeing with the rotation in terms of the momentum that you have been seeing in tech players. You are still looking at some US large cap tech changes. What do you like here?
Well, we like the technology sector as a potential winner in the long run. Clearly, if you look at the earnings profile of the large cap tech companies in the US and even in Asia, they have been on a secular uptrend, beating the broad market earnings quite significantly. And even more relevant is the fact that they've beaten earnings from the value sector quite significantly. And therefore, the outperformance of this sector over the past decade is linked entirely to their fundamentals, which still remain strong. Having said that, the positive news on vaccine essentially gets us to allocate a bit more to certain sectors of the market which were not doing well. And we've chosen small caps in the U.S., for example, to increase our allocations to. We're also buying a little more cyclical names in Asia, for example, exposure to ASEAN, exposure to India, while retaining a core exposure to technology.
Binay, I'm going to just bring you the question of the day that we have, and it is how far will bonds price vaccine optimism? Of course, we've seen this big move on the equity markets as a consequence. So, you know, what matters more to rates markets, vaccine progress or the surge that we're seeing in the virus globally right now?
Well, on the bond side of things, there are three things which are very important, right? As you laid out, Rish, the vaccine yield is very important. And, you know, we saw bond yields move up from the lows. They've been kind of nudging higher, reflecting potentially higher growth and higher inflation. And of course, the medium-term outlook gets sober, better with the vaccine use. So the near-term headwinds are there in terms of cases rising and, you know, countries going back a little bit on the reopening strategies that were being implemented. The other thing that is very relevant for bond markets is the kind of support that the central bankers will provide to them. So despite the recovery in growth sentiment, for example, in Europe, bond yields are still very, very low and deeply negative. That's partly because of the expectations of the ECB announcing an increase in the pandemic emergency purchase program. The critical player, though, in the equation will be the Fed. How does it react to a recovery in growth estimates? They've been fairly cautious so far. Do they start pulling back from the markets? Do they kind of maintain the same level of accommodation? And what is their reaction function to yields crossing 1% on the 10 years? That's going to be very critical. And if they start withdrawing from the market, then yields can go up further. But if they continue to kind of keep financial conditions very easy, which is a core part of their program, then yields should not rise a great deal just on this news. You need to see a significant pickup in growth in the coming months for yields to move up beyond 1%.
Well, the Fed's like other central banks, isn't it, Binay, that they have been able to perhaps provide the monetary framework for there to be a recovery and a fast recovery, i.e. cheap money, etc., and support for various asset classes coming through as well. And by their own admission, many of them say there's not much more that they can do here. Is the monetary policy impotent? Well,
you look at what the ECB is doing. They have deeply negative interest rates. They've been giving TLTROs at minus 1%, and they want to do more because they want to be seen to be doing more. Now, you could debate the actual impact of, you know, increasing your bond purchase program by another few $100 billion or euros. I think it's marginal, but the central bankers want to be seen to be doing enough given what they started a few years back. Therefore, on the Fed side of things, we think they'll be very engaged in the markets generally as long as inflation doesn't meet their targets. And they have a lot of distance to travel before they get to their target on inflation. Therefore, if the Fed starts getting worried about the negative impact of 10-year yields rising too much, you could see them change the composition of the asset purchases to the longer end of the curve to keep the borrowing costs low for the market, or they could announce an increase in their balance sheet expansion program as well.
Binay, what does all this mean for the dollar? Because we've been focusing as well on how economies here in Asia are doing out of the virus. We've been looking at some GDP figures from the likes of Thailand, from Japan, and seeing some pretty good strength in a lot of EM currencies. This is a dollar weakness story. Does that continue?
Yeah, there are two conditions for the dollar to weaken sustainably from here. One is valuation, where the dollar is a little richly valued. No doubt. The second is the equation between growth in the U.S. and growth outside the U.S. At PGI, our indicators suggest that whenever the growth equation is broadening out, take, for instance, the breadth of PMIs in emerging countries or globally, whenever that breadth rises, the dollar tends to kind of weaken a bit. Therefore, if growth in emerging markets starts coming back because of the fact that they are able to overcome the COVID hump, then you will see the dollar strengthen, not strengthen, but weaken a little bit, maybe even stay stable versus euro, but weaken a bit against emerging, many of which currencies are fairly cheap on many metrics. But ultimately, that will be determined by investor belief in the growth recovery in emerging markets. We are generally positive in emerging markets, watching the dollar carefully, and we think emerging markets should have a decent 2021.